And joining me now with more on how we're faring is Bret Kenwell. He's U.S. investment analyst at eToro. Bret, great to have you on the show today. We've seen some choppy trades so far this year. What are you finding when it comes to the markets?
Yeah, thanks for having me. And I think choppy is the way to describe the markets right now, especially when we look back at the last 6 weeks or so on how we've started off this year. But really, when we go back over the last few months, the S&P, when you look at the S&P, it's been running into resistance at 6,100. It's been finding support at around 5,800. And we've kind of been chopping in that range for a couple months now. And so what feels like it's only been 6 weeks or so, it's really been closer to 4 or 5 months. But I think when you zoom out a little bit and you focus more on the long-term trends and what we've been seeing, it's actually been pretty constructive. It's actually not surprising to see this type of consolidation, and in many ways, it's healthy. We've had a big move over the last 2 years in equities. The S&Ps have been up more than 20% in back-to-back years. So to see some sideways action is pretty healthy. Today's CPI report throwing an obvious curveball into the mix today, though.
How are you finding that retail investors are responding to the choppiness?
So far, retail investors have been pretty opportunistic, I think. When we look back, so looking back specifically over some of eToro's data, our clients have been buying the dips, especially when we happen to be kind of coming into these kind of chaotic Monday mornings. The last couple Mondays have been filled with tariff-fueled sell-offs, and we have seen investors step in to buy those dips, thinking most notably of February 3rd, so 2 Mondays ago, when we had the tariff sell-offs around Canada and Mexico, kind of that worry looming. Investors did step in and buy that dip, but they did not buy it as enthusiastically as the dip on the Monday before that, which was the 27th, when we had the DeepSeek news kind of rattle the AI trade. We saw a lot of those big semiconductor stocks fall. We saw a lot of selling in tech, but we saw from our side, we saw a lot of our clients stepping in to buy that dip, and it was actually our largest equity buy order day of the last 6 months. So they really enthusiastically stepped in on that one.
Now, inflation data, of course, was out this morning a little bit hotter than expected and still elevated above the Fed's long-term 2% target. Bret, what does that mean?
Yeah, so today's report is disappointing from a long investor's perspective, particularly active longs. Investors say we're looking for a little reassurance. I think we got that reassurance in in the CPI report from January, as well as the PCE report. Both were reassuring. I think kind of took those reflationary fears down a couple of notches. But when we got today's print, it was hot across the board. Every headline measure was hot. So I think that's kind of stoked those fears again, and it's got the reflationary worries, back front and center. There were some silver linings to the report, I think. One silver lining being that core services continued to inch down. Remember, services are the stickier component to inflation. So to see that number slowly but surely inch its way lower is a positive. Another sort of positive would be that companies might have been front ordering some of their products and materials ahead of possible tariffs, also giving a little boost to that number, but we're not going to know until we get some more reports down the line. And in the near term, that could create some uncertainty if investors are fearful of inflation again.
We'll get word from the Fed chair in just about 25 minutes time. Bret, of course, the second day of his testimony in front of Congress. And yesterday he had shared on the record that he thinks the central bank can move slowly or cautiously with interest rates. Doesn't necessarily need to move dramatically per se. In the wake of the inflation report that we see today, and of course comments from the Fed chair, what does this mean for interest rates?
Before Chair Powell made those comments yesterday, and even before today's report, I think the consensus was that we were not going to have a big year of rate cuts. We ended last year with 4 cuts in the second half of 2024. I think the expectation was that they were going to dial that number in a bit in 2025. And between the comments yesterday, today's report, today's inflation report, I think that is kind of the consensus moving forward. I don't think investors should really rely on or expect a lot of rate cuts from the Fed this year. Ballpark of 1 to 2 seems reasonable at this point.
Bret Kenwell, U.S. investment analyst at eToro. Bret, always good to get your take, especially on the retail trader. Thank you.
Thanks for having me.